Hey everybody, this is Jordan. This video is being recorded on the afternoon of Sunday, March 17th, 2024. For all my Irish listeners out there and viewers, I'd like to wish you a very happy St. Patrick's Day. And for those who aren't Irish, I'd like to wish you a happy St. Patrick's Day. We're nearing the end of the weekend. Hope everyone has had a good weekend. Hope you can enjoy what's left of it. So enough with the pleasantries. Let's get into the video. I'm going to talk about gold stocks and their historical performance against gold, some details behind that, and what we're going into right now, and why gold stocks and juniors, especially over the next year or two, should outperform gold if gold remains in breakout mode. Okay, so there's a lot going on in this chart. I'll try and talk through it without confusing you. But you can see we have gold, we have the inflation-adjusted price of gold, then we have the gold stocks, then we have the gold stocks against gold. Now, the inflation-adjusted price of gold, this data series is from Macro Trends, and this goes back over or about 100 years, which I love. You guys know that. I love to see data series that go back a century. Don't give me 10 or 20 years. That doesn't tell you that much. Give me the whole thing back a century. This is the Barron's Gold Mining Index. It goes back to 1938, actually. Nick Laird from Gold Charts R Us. I don't know if he's doing it anymore. There might be somebody who's managing that site, but Nick has given me a lot of great data over the years. I have been a subscriber, and he gave me some of his own gold stock data to attach to the Barron's Gold Mining Index. So we know that in the early 30s, gold stocks performed very, very well. And so this is the Barron's Gold Mining Index, and of course I always reference this, the 64-65, this epic breakout. First, let's talk about why the inflation-adjusted price is important for gold stocks. And that's because gold stocks, yes, they follow the price of gold, but over longer periods of time, they're going to follow the margins. And so the inflation-adjusted gold price, the real price of gold, that tends to correlate with the margins of gold mining companies. And if you look at these two together, you can notice that they look fairly similar. It's not a perfect correlation, but they're fairly similar. Here we have, look, the late 20s, 1930s, very similar. More specifically, if you get into the last 20 years, you have this big move up here. This is not quite a cup and handle, but you see this here, very similar. And now this. Actually, in the last year or so, these have kind of diverged. Gold stocks should be stronger, but that's mostly due to sentiment. So in the last 9 months or so, mining margins, they haven't really decreased. But share prices came down. That's because of sentiment. So people were selling, valuations went down. So that's why there's been a disconnect over the last year. But nevertheless, we can see, look, this, you're setting up. I mentioned this in another video. This is setting up for a huge breakout eventually. And same thing with the Barron's Gold Mining Index. Again, it's not a perfect correlation, but they're fairly similar. So that's why the inflation-adjusted price of gold matters for the miners. Now, gold stocks against gold. Here are the two key developments as far as why their performance has been so shitty. November 2004, this is the introduction of the GLD ETF. Now, before then, if you were a portfolio manager or a retail investor or a fund manager, you couldn't buy gold. You'd have to buy futures contracts. You'd have to have bars come to your house or whatever. So up until that point, that is why gold stocks traded at a much higher valuation than they do now. And they were one of the only ways you could hedge against inflation. Even at this point in the 60s, more products got introduced in the early 2000s. But it's really important to understand. So you have the introduction of gold ETFs in 2004. Now, if you look at most gold stocks against gold, I think they peaked here, or 2006. They kind of made a double top, triple top maybe. But so that had a huge impact on the market. So all these people who wanted to invest in gold, now they can do it by buying ETFs. Pre-2004, they could not. They had to buy gold miners. And this other reason, this is when gold peaked. This has been a secular bear market. It's more obvious in silver and the gold stocks, but this is a secular bear market. So this is just, it's margins. Think of the last 4 years, how much the cost of mining has gone up. Well, the silver price is down, the gold price, now it's peaked up, but it's just math, people. And you can even go back to 2011. I mean, silver is 50% below where it was. Gold at the same level, but costs have gone up significantly. So that and the introduction of gold ETFs in 2004, that explains why gold stocks have sucked ass against gold. So it's not rocket science. But in the next chart, I'm going to tell you and show you why we are set for gold stocks and juniors to really outperform gold. Okay, so here we have gold. Here we have GDXJ. Here we have GDXJ against gold. Here we have the Huey against gold. And the GDXJ is based on the MVIS Junior Gold Miners Index. And if you're looking at all charting platforms, it's basically the middle of 2009 is when they showed GDXJ started as an ETF. But you go to the MVIS website, you can download data on the index back to this point here, back to January 2004, when gold made a peak and also gold stocks made a peak. Now, this data here, pre-2004, that is data from an old index I had years and years ago. I think it's about 15 stocks. And if you look at the HUI or the CDNX, they did really well in this period. And after 2003, remember Dave Skarica, I did an interview with him about a month ago. He mentioned it. Juniors, they really were flying in 2003. So this data that I attached to GDXJ, that's realistic. And last, these blue vertical lines here, these are when gold began to break out, or when its move to a breakout began. And people, there's 2 times when gold stocks really outperform gold. The first is after crash type bottoms. You had that here, 2008, 2016, 2020. And we can see, if we're looking, here's GDXJ against gold. I mean, look how much they immediately outperformed here, here, here. So that's one point when they outperform. The other is after major breakouts. So again, these lines show you the major breakouts. The yellow here, this shows the Huey outperforming gold. This shows, or Huey versus gold. This shows GDXJ versus gold. And so the yellow shows their outperformance. So after the 2003, 2005 breakouts, they really outperformed. Now, before the 2009 breakout in gold, they were already outperforming. Take that info and think back to where we are now. This massive cup and handle breakout. To me, the biggest breakout in 50 years for the gold market. So this breakout has potential. I think gold could potentially double in the next 2 years. So that is exactly the time you want to own gold stocks and juniors. That is the time when they're going to outperform gold. Now, if there's going to be a move from 2,000 to 4,000, the move from 2,000 to 3,000, that's when you're going to get huge outperformance from the gold miners and juniors. Now, as gold gets to 33, 3,500, that's when the outperformance will probably start to slip and start to fade. So you have to think of gold stocks and juniors. This is the reality. They are basically an option on gold. They do best when gold is really moving and trending. And so that is after a crash type bottom or after a major breakout. Gold has just made a major breakout. This is exactly the time you want to own gold stocks and gold juniors and silver juniors as well. That's the reality. They are an option on gold. They cannot be held for 5 or 10 or 15 years, only shorter periods of time. That's how you use them to gain leverage and make way more money than gold. Let me know what you think in the comments. Thank you so much for tuning in. Hope you enjoy the rest of your weekend. And I'd like to wish you all a great week moving forward this week. Thank you.